Ever wondered how the bid and ask prices of a stock relate to its current price? Here's how it works. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. What are a stock's bid and ask prices? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. To sum it up, someone's trying to buy some stock online, and they're noticing a bit of a puzzle. The bid price is at $13.20 for 200 shares. The ask price is $13.27 for 1,000 shares, but the current stock price shows $13.22. They're scratching their head, wondering why grabbing 1,000 shares seems pricier than what the current price suggests. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that the stock price displayed is typically the last trade price, often just seconds old for liquid stocks. It also mentions that bid and ask prices show what buyers are willing to pay and sellers will accept. Additionally, a market order fills right away at current prices, whereas a limit order sets a price boundary for buying or selling. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. In one response, it's explained that the bid price is what buyers are willing to pay for a stock, while the ask price is what sellers want. The spread, or difference between these two prices, is what the broker earns. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that the current price is simply the last traded price of a security, while multiple bid-ask prices exist across various exchanges. Large orders might be filled at different prices due to volume and these varying bid-ask prices. All or none orders ensure an entire order is filled at once, but only apply to limit orders. Alright, now that we've seen what the community had to say, here's our take on this question. The bid price is the amount buyers are ready to pay for a stock, and when someone sells, that's usually the price they get. On the flip side, the ask price is what sellers hope to receive when they sell. Meanwhile, the current price is simply the last traded price, not necessarily what you'll pay or receive, as it can vary with the bid and ask prices. So here's what we've learned. The bid price reveals what buyers are offering for a stock, while the ask price shows what sellers aim to get. The current price is simply the last traded amount and isn't guaranteed. Whether you can buy or sell at that price hinges on matching those bid and ask prices. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.